explain for my friend George exactly how the dividend futures work. Like, what are they quoted at? They're quoted as the growth percent or the dividend
No,
percent?
so they're actually quoted in dividend index points. So they list contracts. So they're traded on the CME. They're annual. They have quarterly maturities, but we deal with the annual. With the quarterly maturity, sometimes a company's dividend moves from one quarter to the next. You can get moved around, right? But typically over a time period, it's much more stable. So they list the current year and the next 10. So you always have 11 years of contracts. They mature in December of their contract year. Okay. And they're quoted in dollars, but it's index points. And then there's a dollar multiplier that brings it to a certain notional exposure. But the way they work, they're linked to something called a dividend points index. And so for the S&P 500, S&P publishes the dividend points index. And the way that index works is it begins the year at 0. So for instance, the current year, when on the third Friday of 2024 in December, third Friday in December of 24, the final value of that dividend points index determined the final cash settlement value of the futures contract. That next Monday, the index resets to 0. And then every day for the next 12 months that a company in the S&P pays a dividend, S&P takes the dollar value of it and based upon the company's weighting in the index, converts it to a number of index points. And it just tallies it during the course of the year. And so when you get to the end of the year, that futures contract, and today it's trading about 78, but the 2025 is trading at about $78. Whatever the total dividends paid over from December 24 to December 25 will determine the final cash settlement price of that contract.
20 is the
20 to go. So if we bought it for 80 and we get to the end of Q1 and it's at 20, that means $20 of risk has been taken out of the contract and it's been earned. And basically your remaining risk for the next 9 months is now 60. And what you'll see is those contracts will start at like 75, right? And then as the dividend points come in and affirm where the actual growth rate is going to be, the contract will migrate up and they will converge at maturity. And that's the dividend risk premium.
And so
if the S&P goes to the moon and that curve doesn't move, would you rather buy the S&P and pay essentially a massive multiple for earnings 10, 15 years out? Or would you rather buy exposure to earnings in years 1 to 10? You might get better value. It's just a risk market. I think they're just looking and saying, like I don't know what the prospects are going to be 8 years out. And so if you want me to take the dividend risk 8 years out, the regulatory environment, the geopolitical environment, all the stuff that's going on there, I need to get compensated to take that risk. What Metaurus is doing, I think, is a little bit unique because we're looking at these markets to build portfolios and to create systematic, strategies that,
not purely hedging or whatnot.
Yeah, I think in other markets, there's a lot of hedging here. You can trade options on these things too, right? There's no lost premium. There's a dividend risk premium that will erode over time, but you can simply look at, how much option premium am I going to spend to buy out of the money puts or to get exposure to VIX versus the dividend strips. So all these things should have a relationship to each other.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCM Alts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.